Good afternoon, everyone. Yeah, good afternoon, everyone.
Good afternoon, sir.
Jasmina, why is Jasmina joining this class? Jasmina, you can leave. This is a finance class. Yeah. By the way, have you gone through this particular page that I've or this PDF file that I've given you? Have you gone through it? Have you gone through it? Hello, are you there? Rashmi, have you gone through it? These files? Pradeep Gauri, Tejashwini, Papnil, have you gone through the PDF file?
Yes.
Yes, sir.
Okay. Can anyone tell me what is this? Can anyone tell me what is this? See, basically, what we are doing is this is a formula, this is a two-stage formula, okay? And in this particular two-stage formula, we have the first stage, we have this particular stage, we call it as a stage of exponential growth. That means the company will grow at a very fast pace. The growth of the company is very fast. So we call it as a growth of exponential growth at a exponential rate, right? So after it reaches to a certain level, then the growth starts becoming smaller and smaller, and then it flattens out, or in other words, it becomes constant. So when the growth becomes constant, when the growth become constant, this becomes constant. This is the formula that we have to apply. What does it mean? It means that till we reach this particular time frame, till we reach this particular time frame, the company will grow at a exponential rate, which is nothing but GS. The company will grow at an exponential rate of GS. After that, when this time is going to get over, the growth of the dividend, the growth in the company is going to be very, very stable. So when is this particular stage going to start? After completion of this particular time. That is the reason we have to calculate it as dividend n plus 1. So when the exponential growth rate gets over, when the time for exponential gets over, post that the company is going to grow at a constant rate. That is the reason this particular formula is divided into two parts: a stage of exponential growth and a stage where there is a constant growth. What we did in yesterday's class, we saw a stage of constant growth. Sorry, we saw a stage of exponential growth, right? Now, why exponential? Because you had two growth rates. You had two growth rates. One was at 18.5% and one was at 10%. Normally, if you compare, 18.5 is higher than 10%. So there is no need for us to classify which is higher and which is lower. The growth which is higher, we will consider this as an exponential growth, and the growth which is lower, we'll consider this as a constant growth. By using this data, we plotted the first step, or we arrived at the solution for the first step, right? Now we come to the second stage, or the step number 2. In step number 2, whatever is the dividend, whatever is the dividend at the time, what is the time? 5 years. Whatever was the dividend at the end of 5th year, we will consider that particular dividend. So this is the dividend at the end of 5th year, only the numerator part of it. So if you solve this, if you solve this particular equation, or if you solve this particular bracket, what do you get? In your numerator, you get 4.22. So this 4.22 is been considered here as n. So this is considered as dn, that is dividend at time when n is equal to 5. Plus 1 is because after 5th year, the 6th year is going to start. So in the 6th year, what is going to be the growth? The growth is going to be 10%. The growth is going to be 10%. So you have the 5th year's growth. You have the fifth year's growth. You multiply the 6th year growth to it. When you do this, the answer that you get is dn plus 1. So this becomes your numerator. Any doubts in understanding this? Any doubts in understanding this? Any doubts in understanding this, please?
Hello, sir.
Yeah, Priyanka.
Sir, how that 1.1858 came?
Which this one?
No, here in brackets, sir.
How this 1.1858 came?
Yes, sir.
See, what is the formula? D naught. What is your D naught? 1.8. So this 1.8 has come here. Whatever
Yes,
this
sir.
1.8, this has come here. Okay, this 1.8
Yes, sir.
and this 1.8 has come. So D naught is done. 1 is remaining as it is. So this 1 is there. What is there in the formula? Okay.
Okay, sir.
GS. What is the GS? 18.5%. 18.5% is how much? 0.1858.
0.1858.
0.1858. So that is, so when you add 0.1858 plus 1, what do you get? You get 1.1858, right?
Okay, sir.
And this is for the last year, because at the after 5th year, your growth is going to fall down from 18.58% to 10%. So this is the, you are going to stop at 5 years.
Fifth stage.
Yeah. Anything else?
No, sir, nothing. Thank you, sir.
Yeah. So we get this numerator as 4.46, 4.642. This is the numerator. So in other words, I have got the answer for dn plus 1. Now I come to the denominator. What is my denominator? Rs. What is Rs given to me in the problem? Rs is nothing but my required rate of return, that is 20% or 0.2. So I mention here it as 0.2 minus 0.1. From where did I get this 1? Gn is my normal growth rate. If you look here, Gn is my normal growth rate. So I consider this 10% or 0.10 and I substitute the value. The answer that I'm going to get is 4.46.42. right? I get 46.42. So now what I've done by doing this, I have just solved this part. I've just solved this part, nothing else. I need to solve the remaining part. I need to solve this part, right? So how do I go about it? The entire answer here that I have is 46.42. So 46.42 into 1 divided by 1 plus r raised to n. 1 plus r raised to n. So when you solve this, what do you get? You get 2.488. So finally, when you solve this, the answer that the entire answer for this bracket or this particular equation comes to 18.65. Clear? So last step is nothing but addition of exponential growth plus addition of the constant growth. So 8.68 plus 18.65 altogether, the price of your share should be around 27 rupees 34 paisa. The price of your share should be around 27 rupees 34 paisa. So that is what we understand by two-stage model. Getting it? Now remember, these problems you have to keep on solving it. First look at it, solve it. 2-3 times when you do it, only then you'll be able to get this problem, or you'll be able to solve this particular problem. Once if you solve it, you'll not be able to understand it. Clear? Any doubts here? Any doubts, please?
No, sir.
Now there are problems on two-stage model. This is one. I will give you some more problems on two-stage model, solved ones. Okay. We'll go to the three-stage model. Now understand what is happening in the three-stage. Okay. Understand what is happening in the three-stage. In the three-stage, so this is a three-stage model. The company is growing at a constant rate. So we call it as a phase one, or we call it as growth in the phase one. Okay. After some time, something goes wrong with the company. When something goes wrong with the company, there is a sudden fall in the growth of the company, and at some point of time, some corrective actions are taken, some corrective decisions are being taken. The company, instead of going further below, tends to stabilize and tends to go in a horizontal way. So this is the growth phase. This is the phase one where the company is growing. This is the phase two where the company is going to have a decline in its growth, and then some corrective actions are taken. And after taking some corrective actions, the company still stabilizes and then goes on further. So this particular phase, we call it as the three-stage model. Are you able to understand? We call it as a three-stage model. Clear? Now let me explain you the formula first. This part is the first stage. So it is this particular phase. When the company is in this particular phase, we get a equation, or we get a equation something like this. Okay. So just look at this. We are calculating the first part using a growth as GA, right? So this is the growth that we are using, and we are calculating what is the growth that we can experience up to this point. Then once stage A gets over, or the first phase gets over, stage B starts. So stage B, look at what is happening at stage B. In stage B, we have to calculate how the company has slowly come down. This is called as linear transition phase. I repeat, company is not falling straight away down. There is no sudden fall like this. Okay, there is no sudden fall like this. But the company is growing step by step, the company is falling, or step by step, the company is having a decline. It is not having a straight decline. This is a straight decline, right? The company is not having something like this. The company is having a linear decline. So we have to calculate phase B. So how much time has it taken from this point? How much time it has taken from this point up to this point? From this point to this point, how much time it has taken? Okay, so we'll have to take this particular phase as a linear transition phase, and then again some corrective actions have been initiated by the company, and as a result the company starts doing well. This type of a model we call it as a three stage. So this is stage 1, this is stage 2, the decline phase, then some corrective action is taken, then we have a constant growth again, the stage 3. Clear? So this type of a model we call it as a three stage model. Getting it? Okay, now the formula is a bit confusing. You have to remember a lot of things as far as formula is concerned. Remember, there are three growths. One is GA, okay, growth in the first phase. Next, GB, growth in the second phase, and GN, that is growth in the natural phase, that is the last phase. This is the natural growth rate. Clear? D0 stands for dividend, okay, at time t. Here dividend at time t minus 1, because it is falling down, it is falling down step by step. So every year we have to reduce the dividend by a certain number. That is the reason it is called t minus 1. And last one is the dividend that we are going to achieve when the company stabilizes here in the last phase, then it is going to grow at a constant phase. So that is DB, dividend after completion of step number B or phase B. Clear? So R is nothing but required rate of return. I think other things are quite self-explanatory. These are the notations. As I said, dividend is denoted by D0. GA is the growth in the first phase. GB is the growth in the second phase. And GN is the growth in the last phase. Okay. DB stands for dividend at the beginning of the third phase. That means before this particular phase begins, or at the end of this particular phase, whatever is the dividend available, that dividend we have to consider. Clear? Now, let us try to solve this particular example. I want you to go through this point, go through this particular example first, then we'll solve it. Please read the problem. I will explain you how to solve this particular problem because it is a linear transition phase. So I'll explain to you how this linear transition phase works out. Yeah, once you go through this problem, let me know. I'll explain to you. Have you gone through it?
Yes, sir.
Okay. Now, don't worry about how big the formula is, how much should I remember. You have to remember, you have to keep on practicing it. Only then things will fall in place. Without practice, this particular formula, or for that matter, equity valuation, is not possible. You have to keep on looking at the formula, understand the formula, and keep on practicing and writing that formula. Only then you will be able to remember this, right? Okay, now let us see the problem. If you look at it, it says for the first 4 years, XYZ firm assumed to grow at 10%. Fine. So we got the first growth. Okay. After 4 years, the growth of dividend is assumed to decline. That means from 4%, sorry, from 10%, the dividend is going to drop down to 6%. Right. Now, that is not a sudden drop. It is not a sudden drop. It slowly the dividend is going to fall down. Okay. And how do you come to know that the dividend is falling down slowly? Look at this. Okay. After 4 years, the growth in the dividend is assumed to decline linearly. Okay. After 7 years, the firm is assumed to grow at a constant rate of 6%. That means from 10% for the company to grow at 6%, it's going to take around 4 years time. It's going to take 4 years time. So we should linearly decline the dividend in a period of 4 years. So in the first year, we'll decline it by 1%. So from 10%, it becomes 9. In the second year, we'll decline it to 1 more percent. So it becomes 8. In the third year, it will become 7. In the fourth year, it will become 6. And from sixth year onwards, okay, after completion of these 4 years, after 4 years onwards, the company is going to grow constantly at 6%. That is the meaning of the word linear drop. Okay. Now let us see how to work out this. So my dividend, sorry. So they have told me next year's dividend. Okay, so next year's dividend is rupees 2. Required rate of return is 14%, which is given to us. Find out the value of this stock. Now I'll write down what is my dividend. My dividend is 2, which is given to me in the problem. My required rate of return is 14%. My growth initially in the first phase is going to be 10%. I am going to fall from growth A, that is first phase, to the time I reach the third phase. I am going to fall down during the second stage. Now this stage I have to decline from 10% to 6% in a period of 4 years. In a period of 4 years, I have to decline. So in the first year, I declined by 1%. In the second year, I declined by 1. In the third year, I declined by 1. In the fourth year, I declined by 1. Now, why is this equation? Why 1? Why not 2? If you look at it, the answer is here. You look at the formula. It says T minus 1. So whatever is your T, minus 1 is the dividend that you have to keep on reducing. Are you able to understand this? And finally, when I'm going to start my third phase, I'm going to go constantly. I have to grow at 6% onwards. Okay. And my second phase is going to end at 7 years. Or my third phase is going to start at the end of 7 years, right? So this is the formula that I have, and I need to solve this particular problem. So I'm going to solve right now only for first phase. Okay. So I write down the formula for the first phase. I write down the formula for the first phase and I keep on solving it. I try to solve it. Clear? Now, please pay attention. Okay. It says dividend for the next year. In the problem, read it clearly. It says dividend for the next year. So next year dividend is 2 rupees. So if I am going to receive 2 rupees next year, what is the present value of that dividend? I need to find out. So here I have not multiplied the growth, even though the formula says 1 plus G. Okay, I have not taken the growth because next year onwards I will experience the growth, but this year I don't have the growth. I am trying to find out the present value of this particular dividend. So I just write down 2 in my numerator, and as it is given to me in the denominator, I substitute those values. So it is 1.14 raised to 1 because it is in the first year. Okay. Yeah. What I want you to is please read this, and if you have any doubts, I'll explain to you. Please go through this. Please go through this. If you have any doubts, please ask me. Please tell me if you have any doubts. Any doubts, please? Okay, I'm running out of time. Okay, so I'll just explain to you. The first part is quite simple to understand. There is nothing much to explain here. The second phase is important because there is a linear transition that is happening. Okay, I'll explain to you what is the stage 2. It says, just pay attention. It says, okay, you are going to have this part. Okay, so that is your dividend. Dividend is rupees 2. Okay, dividend is rupees 2. That is what you are going to have. Okay, now this dividend at the end of third year, how much will be the value of this dividend at the end of the year, the 3 years? Okay, this is the value of dividend at the end of 3 years. Only the numerator part of it. I repeat once again, just consider the numerator part of it. This is going to be the value of your dividend at the end of 3 years. After third year, after 3 years, the fourth year is going to start. Once the fourth year is going to start, you are going to experience a decline. So we are going to consider the dividend at the end of third year, right? Thereafter, in the fourth year, okay, you are going to have a decline by 1%. So if you are going to have a decline by 1%, okay, so it is going to be 10 minus 1, that it becomes 9%. So 9% is nothing but 1.09. So this is going to happen in the fourth year. This is going to happen in the fourth year. Clear? In the fifth year, 1.9 into 1.8, because 2 years are coming here. Next 3 years are coming here. So this is how the second phase is going to happen. This is where the second phase is going to happen. Okay, please tell me if you have understood this. This understanding this part is very important. Even if this is not, if you are able to handle it, this should be very, very clearly understood. Please tell me if you are able to understand. If not, you take your time today. You take your time, go through this, okay, and then we can continue. Of course, this part is very simple to understand. There's nothing new in understanding. Phase B is only critical to understand. Okay, so I'll just wait here. Take your time. I have 3 minutes left. Okay, take your time, go through it. If you have any doubts, please raise the doubts. I'll clarify it immediately here itself. So tomorrow's class mostly will be the last class for equity valuation. Then on, I am going to start with fundamental analysis, which is very important. Any doubts, please? I want everyone to come in the video mode, please. Yeah, are you able to understand this equation of third three-stage model, two-stage model, or it is becoming very difficult for you to comprehend?
So only formula is confusing.
I cannot cut down the formula. See, it happens because you're looking at this particular formula for the first time, right? If you keep on practicing it over and over a period of time, things will be easier. Yeah, I know this. When I started teaching this, it became difficult for me also to teach, because, and that too on an online method, it's becoming even more difficult for me to teach, right? Because I cannot uh, share the doubts. If you are in a classroom, probably you will have common doubts, or you will have some doubts as to from where did this value come, or why should I take it in that particular fashion. All these doubts cannot be explained or raised in an online session. So my sincere request to you would be, in case you have any doubts, some of these students are coming to the campus. If you have any doubts, you can come and clarify your doubts in the college. Okay, the college is open, students are coming, some of the students are coming, but there are no classes as such. Students are coming to clear off their doubts. So if you have any doubts, you can definitely come. I'll clarify all your doubts, no problem. Is that okay? Anyways, tomorrow what we'll do is, you go through this three-stage model. Okay, and once you go through this three-stage model, tomorrow I'll spend one more day on three-stage model, uh, and then we'll proceed with the fundamental analysis. Remember, fundamental analysis is the crux of investment management, right? So what we have done up till now is we have just laid the foundation. We have not gone actually into analyzing the shares. We are just putting up a foundation. And from Saturday's class onwards, I will start with fundamental analysis, and that is where things will really start. You'll really start understanding what is happening in the field of investments. Is that clear? And if you develop interest in that fundamental analysis, technical analysis would be very easy for you to understand. Yeah. Technical analysis, I'll be showing you a live platform, because I cannot explain you technical analysis by showing some pictures and charts. I have to demonstrate how actual trading takes place. So I will show you the candlestick charts and the trends that happen. Accordingly, we will see how to go about it. Clear? So tomorrow's class will be the last class on equity valuation, that too on three-stage model. Okay, that is if you want it. If not, we will stop it. Yeah. So tomorrow I'll be ready with three-stage model also, and I will also be ready with the fundamental analysis also. Clear? Whichever you feel, we will start accordingly. Okay. And one more, I don't know whether it is a good news or bad news. It should be a good news to all of you. Your tax paper this time, final exam tax paper, would be mostly, I'm saying mostly, theory. Your tax paper this time would be mostly theory. This is an update that I have got. Now don't ask me what theory. Theory means everything. Okay. But that does not mean you ignore the problems. Okay. This is VTU. They will suddenly change. Okay. It may come 20% problems. It may come 20% theory, 80 marks problem. Then we'll have a big problem. Okay. But tentatively, they are trying to stick with at least 25 marks of problems, 25 to 20 marks of problems, and the remaining would be theory. So more focus would be given on theory, and less focus, because of online mechanism, is given on problem part of it. The same would also be applicable for investment. Only thing is, ratio is not 50-50. ratio is going to be 40/60. Clear? So this is the latest update that I've got, and let us see what happens. Okay, as far as your syllabus completion is concerned. Clear? Yeah. Any doubts here? Okay, I'll just take the attendance. There are only 16 people. The moment I said I'm going to take attendance, see how the number is increasing. Okay, just wait. Yeah, fine. So I'll stop the class here and I'll meet you tomorrow in the regular classes. Okay. Thank you.